Welcome back to the Real Estate Beast podcast. I'm Michel, and today we're diving into a topic that's crucial for anyone looking to buy property: interest rates and the impact they have on buying power. We'll explore how interest rates affect your ability to purchase a home and how they relate to the price of the property. Let's get started. First, let's define buying power. Simply put, buying power is the amount of money a buyer can afford to borrow to purchase a property. This is heavily influenced by the interest rate set by banks for home loans. When interest rates are low, buyers can afford to borrow more money because the cost of borrowing is cheaper. Conversely, when interest rates are high, the cost of borrowing increases, reducing the amount of money buyers can afford to borrow. Let's break it down with a simple example. Suppose you're looking to buy a house and you can afford a monthly mortgage payment of $2,000. If the interest rate on a 30-year fixed mortgage is 3%, you can borrow more money compared to if the interest rate would be 5%. Now, at a 3% interest rate, you might be able to afford a $475,000 house. At an interest rate of 5%, your buying power drops and you might be able to afford a $375,000 house. This demonstrates how crucial interest rates are in determining what kind of property you can afford. Now, let's discuss the relationship between interest rates and property prices. Generally, when interest rates are low, property prices tend to increase. This is because lower interest rates make borrowing cheaper, increasing demand for homes as more people can afford to buy. Higher demand usually drives up prices. Conversely, when interest rates rise, borrowing becomes more expensive, reducing demand for homes. This can lead to a slowdown in price growth or even a decline in property prices as fewer people can afford to buy. Consider a scenario where interest rates drop from 5% to 3%. This reduction means lower monthly payments for borrowers, increasing their buying power. As a result, more buyers enter the market, driving up demand and pushing property prices higher. On the flip side, if interest rates increase from 3% to 5%, buying power decreases. Fewer buyers can afford homes, reducing demand and potentially leading to a stabilization or decrease in property prices. Given the impact of interest rates on buying power and property prices, here are a few strategies for prospective home buyers. Monitor interest rates. Keep an eye on current and projected interest rates. This can help you time your purchase to take advantage of lower rates. Lock in rates. If you find a favorable interest rate, consider locking it in to protect yourself from potential increases before you close on your loan. Evaluate your budget. Understand how different interest rates affect your buying power and adjust your property search accordingly. Use online mortgage calculators to see how various rates impact your monthly payments and overall affordability. Consider adjustable rate mortgages, ARMs. While fixed mortgage rates offer stability, ARMs can start with lower rates that adjust over time. This can be a good option if you plan to sell or refinance before the rate adjusts. Before we continue, it's important to understand that interest rates on mortgages and other loans aren't just arbitrary numbers set by banks. They are influenced by broader economic factors, primarily benchmark rates like those set by the Federal Reserve in the United States or the Euribor in Europe. Let's break down what these terms mean and how they affect the interest rates you pay. The Federal Reserve, often referred to as the Fed, is the central bank of the United States. One of its key responsibilities is to manage the country's monetary policy, which includes setting the federal funds rate. This is the interest rate at which banks lend to each other overnight. It directly impacts the cost of borrowing money for consumers and businesses. For example, if the Fed lowers the federal fund rate, banks can borrow money more cheaply. They often pass these savings on to the consumers in the form of lower interest rates on loans. Conversely, if the Fed raises the rate, borrowing costs for banks increase, and they typically raise the interest rates on loans to consumers once more. In Europe, a similar role is played by Euribor, which stands for Euro Interbank Offered Rate. This is the average interest rate at which European banks lend to one another. It's calculated daily and is used as a benchmark for a variety of financial products, including mortgages and savings accounts. There are several Euribor rates, each for different lending periods ranging from 1 week to 12 months. These rates are influenced by the European Central Bank, the ECB, and reflect the overall health of the European economy. When the ECB adjusts its key interest rates, Euribor rates usually follow. For instance, if the ECB lowers its rates to stimulate economic growth, Euribor rates typically decrease, making borrowing cheaper for consumers and businesses. If the ECB raises rates to combat inflation, Euribor rates increase, making loans more expensive. So how do these benchmark rates affect your mortgage interest? When the Fed or ECB adjust their rates, it directly influences the interest rates that banks charge each other. This change trickles down to consumer loan rates, including mortgages. These rates also signal the health of the economy. For example, lower rates typically indicate efforts to stimulate economic growth, which can lead to increased borrowing and spending. Higher rates often signal attempts to cool down an overheating economy and to control inflation, leading to reduced borrowing and spending. Banks use these benchmark rates as a reference point to set their own interest rates. While individual banks might offer slightly different rates based on their policies and the borrower's creditworthiness, the general trend will follow the Fed or Euribor rates. To put it in practical terms, if the Fed announces a cut in the federal fund rates, you might see lower interest rates on new mortgages and potentially on adjustable rate mortgages as well. Similarly, if the Euribor rates increase, mortgage rates in Europe are likely to follow suit, making it cheaper for consumers to finance their home purchases. Understanding these connections can help you better anticipate changes in mortgage rates and make more informed decisions about when to buy or refinance a property. Now that we understand the role of the Fed and Euribor in setting interest rates, let's delve into why these rates have risen in recent years and why they tend to come down again over time. One of the primary reasons for rising interest rates is to control inflation. Inflation occurs when the price of goods and services increase, reducing the purchasing power of your money. Central banks like the Federal Reserve in the US and the European Central Bank in Europe raise interest rates to make borrowing more expensive. This in turn reduces spending and slows down economic activity, helping to keep inflation in check. Another factor contributing to rising interest rates is strong economic growth. When the economy is growing rapidly, it can lead to higher inflation as demand for goods and services increases. To prevent the economy from overheating, central banks may raise interest rates. This slows down borrowing and spending, helping to balance supply and demand. Low employment rates and rising wages can also lead to higher interest rates. When more people are employed and earning higher wages, they tend to spend more, increasing demand and potentially driving up prices. Central banks respond by raising interest rates to prevent inflation from spiraling out of control. Interest rates don't stay high indefinitely. When the economy slows down or enters a recession, central banks often lower interest rates to stimulate growth once more. Lower rates make borrowing cheaper, encouraging businesses and consumers to take out loans and spend more. This increases activity and helps to revive the economy. Now, when inflation starts to decrease, central banks may reduce interest rates. Lower inflation means that prices are stabilizing and the risk of a runaway inflation diminishes. By lowering rates, central banks aim to make borrowing more effective, which can boost spending and investment. Financial market instability or crisis can also lead to lower interest rates. During times of uncertainty, such as a financial crisis or a geopolitical tension, central banks might lower rates to provide liquidity and support the economy. This helps to restore confidence and stabilize the markets. Interest rates can also be influenced by global economic conditions. For instance, if major economies around the world are expecting slow growth, central banks may lower rates to prevent their economies from being adversely affected. Similarly, coordinated efforts by multiple central banks can lead to lower global interest rates. To illustrate this, let's consider the period following the 2008 financial crash. Central banks around the world, including the Fed, drastically cut interest rates to near zero levels to support economic growth. This made borrowing cheaper, encouraging spending and helping to revive economic growth. As the economy recovered, interest rates were gradually increased to prevent overheating and control inflation. Now we've talked about how interest rates are set and why they fluctuate. But now let's focus on what we as consumers can actually do about it. While we can't influence interest rates themselves, we have significant control over how we structure our mortgage loans. Options like fixed rates, variable rates, and balloon payments offer different advantages and risks. Additionally, it's crucial to remember that loans are a financial product, and you should investigate them as thoroughly, if not more so, than the property you're buying. First, let's look at the fixed rate mortgages. A fixed rate mortgage offers stability because the interest rate remains the same throughout the loan term. Here's how you might consider a fixed rate mortgage. Number 1, predictability. Your monthly payments remain constant, making it easy to budget and plan your finances. Number 2, it protects against rate hikes. You're shielded from future interest rate increases, which can be especially beneficial in a rising rate environment. Number 3, long-term stability. If you plan to stay in your home for a long time, a fixed rate mortgage can provide peace of mind, knowing that your rate won't change. However, keep in mind that fixed rate mortgages often start with higher interest rates compared to adjustable rate mortgages. Next, let's discuss variable rate mortgages, also known as adjustable rate mortgages or ARMs. With an ARM, the interest rate is fixed for an initial period, typically 5, 7, or 10 years, after which it adjusts periodically based on a benchmark rate. So here are the advantages. Number 1, lower initial rates. ARMs often have lower initial interest payments compared to the fixed rate mortgages, which can result in lower initial monthly payments. Number 2, potential savings. If interest rates remain stable or decrease, you could benefit from lower rates in the future. Number 3, it's flexibility. ARMs can be a good option if you plan to sell or refinance before the adjustable period begins. However, the biggest risk with ARMs is the uncertainty. After the initial fixed period, your rates and monthly payments could increase, sometimes significantly, and you might be caught in a downward spiral where you have to pay more and more for your mortgage. Lastly, let's consider the balloon payment mortgages. These loans require you to make regular payments for a specific period, followed by a lump sum payment to pay off the remaining balance at the end of the term. Some of their characteristics are as follows. Number 1, they have lower initial payments. Like ARMs, balloon payment mortgages often have lower initial monthly payments. Number 2, short-term strategy. This means that these loans can be beneficial if you plan to sell or refinance before the balloon payment is due. And number 3, there are some risks. The major risk of this large lump sum payment at the end of the term is that if you are unable to refinance or sell the property, you could face significant financial pressure. These payments can be beneficial for those who have a specific exit date in mind. In this case, this type of loan can help reduce the monthly payments, but requires a specific sum at the end of the loan period. It's crucial to remember that a mortgage loan is a financial product. Just like you would thoroughly research a car or an appliance before making a purchase, you should investigate mortgage loans even more thoroughly. Here's why. Number 1 is cost over time. The total cost of a loan can vary dramatically based on the interest rates and terms. A lower interest rate can save you tens of thousands of dollars over the life of the loan. Number 2 is terms and conditions. Different loans come with different terms and conditions. Understand the fine print, including fees, penalties, and adjustment periods. Number 3, lender reputation. Research and choose a reputable lender who offers good customer service and competitive rates. Your relationship with the lender can impact your overall experience and financial well-being. Number 4, consult professionals. Consider speaking with a mortgage broker or financial advisor. They can provide insights completely tailored to your financial situation and help you find the best loan product for your needs. To wrap up, understanding the intricacies of interest rates and how they impact your buying power is crucial for any real estate investment. While we as consumers can directly influence interest rates set by the Fed or Euribor, we have substantial control over how we structure our mortgage loans. By choosing the right type of mortgage, whether it's a fixed rate, variable rate, or balloon payment, you can better manage your financial risks and take advantage of favorable conditions. Remember, a mortgage loan is a financial product, and just like any other major purchase, it deserves thorough investigation. Understanding the terms, conditions, and long-term costs can make a significant difference in your financial health and investment success. Stay informed about the broader economic factors influencing interest rates, but also focus on the choices you can make regarding your loans. By being strategic and well-informed, you can navigate the complexities of real estate financing and achieve your investment goals. I want to thank you for tuning into the Real Estate Beast podcasts. Now, if you have any questions or topics you'd like me to cover, feel free to reach out. Until next time, happy investing.